Hello and welcome to the Mutual Fund Show. My name is Neeraj Chan. Over the next 25 minutes, we'll talk about a specific bucket of mutual funds, which are always interesting to talk, and more so in these times. Now, viewers, a lot of you tuned in for the interaction that we had with Samit Vartak of Sage One Investment Managers earlier on Wednesday morning. And I think some of the statistics that were shared were pretty interesting. If you look at the top 100 companies within the NSE 500 universe, the average multiples might still be very high, maybe 20, 21 times. But the bottom 100 have multiples which are average multiples of maybe 6 times. And some of these are still business leaders as well. So the question therefore is that is it foolhardy to not look at small caps thinking that, oh, small caps are risky and large caps will be the first ones to bounce back? I guess DSP Mutual Fund doesn't think so, because if my information is not wrong, they have started accepting lump sum investments in their small cap funds, something that they stopped some time back. So to talk about the very nature of why they've done this, and of course their whole view on the small cap universe, Kalpen Parekh and Vinit Sambre need no introduction. They've been with us in the past as well. And gentlemen, both of you, thank you so much for joining in. Kalpen, what's the thesis? Why is it that you have decided to accept lump sum investments all over again?
Thanks, Neeraj, for inviting us in this call. Our thesis is basically, the whole approach of managing our small cap fund at DSP. The fund is around 13 years old now. And the small cap index, from which we do selection of good companies through a fairly scientific investment philosophy framework, that index is now almost at 2007 prices. So, 13 years of no return from the index. The small cap fund, like you started off by saying, while the name is small, the volatility is always large, and hence calibrating your entry and exit becomes very important. Somewhere very early in 2017, Vinit, who heads equity and manages the fund, has been managing it for a long period of time, highlighted that I would like to, stop taking money in the fund because the fund was 7,000 crores in size, and that was a very euphoric phase. Prices were going up every day, and it was not a buyer's market; it was a seller's market. Someone who wanted to sell stocks was getting advantage of that. So we decided to stop taking all flows into the fund, whether it was lump sum or even new SIPs. Since then, 3 years have passed, exactly 3 years and 1 month, and we've seen valuation multiples almost more than half, whereas the operating companies continue to fulfill the criteria that we have for any company across the universe of funds at DSP. So you're getting good companies at reasonably low prices, cheap valuations, and we feel that these are good times. Small caps have very quick or volatile cycles. It's better to raise money when it becomes a buyer's market, when you are able to buy companies of your choice in meaningful chunks, and you are at a cycle low, so that when the next round begins, when the next 5-year cycle plays out, investors get advantage of that. We feel money raised in this phase, not necessarily today and tomorrow and in the next few days, but in the next couple of months, would stand good chances of capturing an upcycle, because we are sitting at a down cycle of almost 4 or 5 years, and in the last 2 years itself, our own NAVs have fallen by around 35-40%. The index has fallen a lot more. So we are happy to take money when prices are falling, because as prices fall, if the hypothesis that the underlying companies are good is intact, lower prices means relatively higher margin of safety or relatively lower risk, and we are happy to get more money at this point in time.
Vinit, Kalpen and Kalpen has already explained beautifully about what the logic is, but as the fund manager, why the current point of time that there could be further damage in the small cap universe, right? We're not out of the woods as far as the biggest scare for the world markets in the last decade goes.
Yeah, Neeraj, I think you are right. This may not be the low point right now, but I don't think ever any investor was able to capture the low points in the market. And instead of really going ahead and predicting what will be the low point of the market, what will be the low point of the stock, I think what measurement criteria which we sort of are using is, let's say, if the intrinsic value of the company on the basis of our long-term assessment of the business matrix, if the intrinsic value falls much below sorry, if the current market price falls much below than the our expectation of the intrinsic value, then I think there is room for an opportunity for the investors. In the same breath, in 2017, when we had shut the fund, we had actually felt that the current market prices were reflecting a much higher point as compared to their intrinsic value. And that was the point we felt that it may not be in the best interest of the investors to keep pumping up and keep buying these stocks. And now that there is scare all around, people are afraid, and who knows that this may not be the low point. Probably when we hit the peak of the epidemic, that may be the low point. But what we want to do is that that will be also a time where investors' courage and sentiments will also not give him enough ammunition to go ahead and put money. So I think what we are trying to indicate to the clients is that it's not that from now onwards things will start moving up as far as the small cap is concerned, but the attractiveness of the category is relatively much better today. And if we were if we were in receipt of flows into the fund now, I think the kind of companies which we can buy, considering that the businesses have not got impacted on a long-term basis, I think that opportunity is coming up. So I think that's the whole logic, Neeraj.
Okay. Kalpen, there's a very interesting statistic that I think Yash from our team got out, and I don't know whether you passed it. I mean, your team passed it or otherwise, but it said that, for example, I think for your fund or for the small cap space, the lowest ever 1 year return has been negative 67%, but the highest ever return is northwards of 200%, and the lowest average CAGR, 10-year CAGR, is about 11%. Now, what is it that comes out of this? Does it say that I mean, that if you buy into quality small caps as well, over a period of over a slightly longer period of time, there is money to be made, irrespective of the market scenario?
Neeraj, these are valid statistics that we have released just today morning on social media. In the spirit that we always want our investors to visualize the risk upfront before they invest and not after they invest. So, we are very, very keen at all points in time to show investors both sides of the coin. One side of the coin which shows what could have been your worst case return. So minus 67% is the return that the fund had gone through in 2008 global financial crisis. The index had fallen, small cap index had fallen 75% or something that time, and the fund had dropped by 67%. This is just to make investors aware or recognize that equities have risk and small caps also have risk. But on the other hand, what we are also highlighting that if you really give time to your investments over a long period of time, you are able to make significantly better returns than fixed income. But that long period has to be 7 to 10 years, not just 3 to 5 years, which is what typically many investors tend to look at. More importantly, we've always said this, even on your show, that good companies are good companies, not necessarily large, mid, or small. So the hypothesis is that we are buying good companies. We are putting together a portfolio of 40, 50 good companies around a very robust, well-tested investment framework, which has been in play over the last 10 years. And we have put out this framework also in the public domain in terms of the filters that we apply to select companies and equally important filters that we apply to eliminate companies. There's a lot of emphasis on forensic analysis. We have a separate role called skeptical analyst in Vinit's team, whose job is to look for where can accidents happen, where can there be governance red flags. So we try to minimize permanent accidents. So the message to the investor here is, over a long period of time, what can be your worst case return? We are happy to show worst case returns rather than show best case returns because, more often, very few investors invest in a down cycle and get the best case return. Best case return ends up only being in our fact sheets. We want investors' account statements to get better returns, and that tends to happen normally when investors invest in a down cycle. So the whole idea of conveying this data point is to highlight risk, but at the same time also highlight that if you stay put for a long period of time, even if you had invested on a wrong day 10 years back, your worst return was 10%. CAGR.
And you reckon, Kalpen, that the risk reward at the broader end of the spectrum is a lot more reasonable and favorable right now, I guess, which is why the lump sum, because you started off the investments in reopened the small cap fund itself, I think, some time back, and I think we had a chat there, but the lump sums are now being opened up. So you clearly believe that the risk reward is completely in favor of starting to invest even in a lump sum fashion in the small caps.
It's getting better.
Getting better. Okay. I like the term, the skeptical analyst bit. I'll talk to Vinit about that in a moment from now. It's not something that I've heard generally. But Vinit, the other question is this, that the broader investment thesis has always been that go out and buy leaders because leaders tend to do well. Now, my question is, on a relative basis, because you as a house, and maybe Kalpen might be also wanting to get into this conversation, and feel free, Kalpen. I just wanted to understand that as a house, you have large cap, mid caps, you have this quant fund, which is investing into high companies and almost large cap companies. And almost everybody that I speak to in the market, Vinit, and maybe you might have the thought too, that when the bounce comes back, once this dust settles down, the large caps will be the first one of the block. So on a relative basis, would you believe that because of the price damage, small caps are still more attractive than large caps, or would the first port of call be large caps and then some bit of money should also go into a small cap fund? How do you kind of differentiate between the two?
See, I would not really like to guess about how what type of capitalization, what companies are going to sort of be in the front runner when the things come back. Surely, in the first port of call is the large cap, as we start seeing some semblance back in terms of the recovery. But for me, I think it has been that if the companies, if the businesses, they start performing well, if the visibility of the growth comes back, then I think those companies have to perform. And in the past, if you were to just track some of these lead and lag between the large cap, mid cap, and small cap, I think the mid caps and large caps, by and large, typically have a very narrow lead and lag. The mid caps tend to catch up faster, and the small caps are probably in the line. They are ranked the last, and for the small caps to really go up, it needs sustainability of economic growth. It needs sustainable visibility of growth coming back. So I agree on that in terms of fundamental aspect, the small caps would require much stronger fundamental and stronger economic growth, and that to sustainability of that. So I think from that perspective, if we have to think about our economy, we have been in a low cycle for a long time. We were building up a type of scenario where we were looking for a back-ended growth. Now, because of this COVID-19, the growth maybe probably got pushed back some bit. But hopefully, as and when we revert to our normal levels of growth, and there is a sustainable growth which comes back, I think all type of companies, good companies which work with a leadership type of a profile, which work with a cash flow in mind, which work with high capital efficiency factors, and which probably I can say that they have some unique advantage over the others. I think those companies over a period of time will tend to create value, and this is what we have experienced in case of our small cap. So I think for as far as the investors are concerned, for them to also very accurately time that we start off by allocating 100% to large cap, and then when the rally in cap is over, immediately make a shift to the mid cap, and then when the rally in mid cap is over, let me switch back to the small cap. I think that's going to be a very Herculean and impossible type of a task. So the better way is to have the allocation done at the juncture where one feels the valuations are in our favor, and then it's all about patience. Probably small cap may require slightly more patience. That patience pays off in terms of the return metrics. So I think that's what I would think so.
Okay, relative to itself, Vinit, what's the kind of opportunity do you see? What kind of companies do you believe your fund would house? I heard Kalpen say a statistic of some 40 to 50 companies. Is that the total universe, or the rather the investable universe from which you'll choose company, or will the fund house about 40, 50 companies? Can you give us some details so it gives us an idea, or give viewers the idea about what kind of companies are you as a fund manager looking to go out and choose?
So see, universe is wide and large, and as a house, we track some 270, 280 odd companies, and this basically includes all the large, mid, and small cap companies. But for us, it is open. Let's say if some companies which by and large are looking good in particular cycle, and if we don't have under coverage, we are provided that they meet all our criteria, then we can bring those into our universe as well. So I think in a way universe is sort of open, but as a house we keep tracking, let's say roughly 300 odd companies in that range. Now the opportunities today, I may say that you in your initial remark you mentioned that there are some analysis done, the bottom 100 companies are trading at single digit PE. So one in a couple of sectors today we are seeing that these stocks are actually hitting double digit to high single digit type of multiple. In some cases, it's a very low single digit multiple which the companies have cracked down to, and also and these may, let's say, within the auto ancillary, these may be within the textile pack, these may be somewhere in the chemical space, some pharma names selectively, and beyond that, the other factor which is also very relevant is all these while the consumption oriented companies were hitting high point in terms of their valuation metrics. Now the companies which used to trade at 40, 45 or even higher multiple, we have seen them tracking down to between 20 and 25 multiple. Now the earnings itself is something which which earnings you want to take, because this year may be a washout year, but I am saying on a stable scenario basis, if these companies were to perform and if I were to assume those earnings, then I think these companies have cracked down to decent multiple. Now so the opportunity set is wide and large across the board. Good companies within the consumer basket is one area where we are looking for an opportunity. There are agri-based, agri-oriented companies where we are seeking opportunities, and there are few financial names where where the damage is not likely to be as high, and where the quality of assets is within our given parameters. I think we are looking at such names within our category.
We need just a follow up though. Are you? I mean, there are a bunch of mid-sized companies which have uh, been derated a lot more to some people's minds, been derated a lot more because of the situation than what they should have, and business is okay. And there are some in which there has been a bit of business stress, and therefore the valuation of pull down is just so dramatically low that they are probably available at levels closer to the global financial crisis or otherwise. Do you reckon there could be a mix of both, or are you as a small cap fund manager first looking to buy good businesses and then the filter goes on to the valuations? How is it that you're approaching this space right now?
I think it's a combination. You can't keep them two separate. So, at a point in 2017, at a peak, you had good businesses, but the valuations were not comforting at all. So, you were in some form or fashion discouraged to buy those. Today, what is happening is that good businesses and good valuations are sort of coming at one point in time, which is I think is a good opportunity per se.
Okay. Kalpen, just a small thing that happened yesterday as well, and just wanted to wonder, not just with regards to small caps, but general equities, that the cut in the small savings rate. Now, we've been arguing about this for so long that at some point of time, people banking upon the small savings rate staying high would keep on being there and not look at other options. Does this make the case for investing in equities and maybe mutual funds, because even debt mutual funds probably give much higher returns right now than the small savings? But broadly, does this make the case for investing in equities at these valuations much even more compelling, just because of the fall that we've seen now and likelihood of more cuts as well if interest rates are on the way southwards?
So, Neeraj, I tend to keep these two buckets separate, because every investor has a safe bucket which goes into small saving, provident fund, fixed deposits or debt funds, and there is a growth bucket, which is basically stocks and equities. I would appeal to a lot of investors who themselves buy direct stocks in the market, especially in the small cap universe, where the volatility is very large, and over a full cycle, more often we realize that no return is made or there is actually loss of capital. Through a fund management platform with the right processes and risk frameworks, what we are looking at is buying companies with high ROCs, very low leverage, owning for a 4-year, 5-year minimum time horizon. So I would like to attract that pool of money into the small cap fund. Now, of course, the alternative rate of interest or opportunity set has come down with the PPF rates, etc., being brought down. But that investor, in my experience, normally when he sees that, okay, equities are falling by 20, 30, 40%, behaviorally, an investor who's seeking the comfort of capital protection is unlikely to move to equity just because these yields have come down by 100 basis points. Because the mindsets are very different. This is a protection mindset, whereas equity funds or even the small cap fund.
Okay. I think we're just losing Kalpen's feed, but I think we broadly gotten the answer. Okay, one final thing, and something that I said that we will talk to both Vinit and Kalpen about, but Vinit, I'll come to you first. What is this skeptical analyst function? Tell us about it.
Yeah, so see the way we have sort of analyzed the companies, and especially within the small and mid cap range of businesses, I think the risk of companies going down under or companies getting bust is much higher than the outperformers release. And essentially, if we observe the last 3-4 years, the issues relating to governance, the issues relating to capital misallocation, issues relating to the, let's say, the regulatory bottlenecks. I think most of these issues have had a significant amount of impact on many businesses and many companies. So I think from that perspective, it is when we are having a significant amount of assets under management within the small and mid cap category of stock, we felt that it is prudent to have someone who really has an eye on some of these issues and red flags, which probably we can come up with slightly ahead of time and allow ourselves to safeguard from investing or getting caught into such wrong investment. So I think from that perspective, this role was carved out, and we have one person who's sort of taking care of this type of a research, and his role principally is actually goes beyond the regular research. The idea is to look at the various related party transactions, look at various connected companies, look at various promoter activities which are publicly available on various data information vendors and all that. And I think from that perspective, to dive deeper into their financial metrics, their accounting metrics, and if we are able to sort of get the red flags highlighted early on, then probably the idea is to safeguard ourselves from wrong investment. So I think that's the whole summary of why we decided to go with the skeptical analyst.
Okay, well, gentlemen, we wish you all the best with this fund, and well, there are more reasons than one for wishing this fund to do well, because that would also mean a bit of a resurgence in the market. So that is also important. But remember, when noted fund houses and funds with track record tend to take actions, then they at times tend to provide some indications about what the directions could be as well. So is this a bit of a moment which could mark a zone from which maybe even small caps could bounce back? That's the key question that viewers, you got to ask yourself. But Kalpen, Vinit, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
According to a recent report, women today contribute nearly